In today's dividend investing video, I am going to share the top 3 stocks that I am personally buying right now in March and April of 2019. Let's get started. All right, everyone, I am back with another video about dividend investing. I apologize if my voice is not that good today. I am facing a very rough cold right now and fever, but I want to keep pressing forward with my YouTube channel, so I hope you guys appreciate the video today. The 3 stocks that I am buying right now in March and April. Let's jump right into it. PepsiCo is the #1 stock that I am buying right now. If you've been following my channel, I'll link in the description below. You know that I've been selling some items on eBay, and some of the profits that I've been generating from eBay, I am deploying into PepsiCo. I'm building that position. This is my #2 favorite stock of all time. I want it to be massive. I want it to be as large of a holding for me as my #1 favorite stock of all time, Johnson & Johnson. It's not there yet. It actually represents 4.87% of my portfolio. I'd like to see it get up to like 6 or 7, or maybe even 8% of my portfolio. So I just have to keep adding to PepsiCo. Now, overall, of the 3 stocks that I'm sharing today, Pepsi is the least likely to be called a value stock. It is certainly not a value stock. It is fairly priced, if not overpriced right now, but I am buying it because I love it. It's my #2 favorite dividend stock of all time, and I want to bring it to size. I want it bigger in my portfolio. So I'm actually buying this one monthly in 2019, but I'm also adding extra money to it from the profits that I'm generating from selling some of my items around the house, decluttering and selling them on eBay. And so right now it's trading at $121 and change. When I look at the 5-year chart, it's basically near a 5-year high. So the price has certainly trended up. The estimated earnings per share for 2019 from the analyst comes in at $5.51. That gives me a forward PE. If I take the current price, I take the estimated, divide it by the estimated earnings per share from the analyst, give me a forward PE of 22.12. 22.12 for Pepsi, in my opinion, is a fair PE. It's kind of expensive. I'd like to buy this one under 20. That being said, I am buying now literally to bring this 4.87% of my portfolio up to like 6, 7, or 8. I need it to be bigger because I love this company, and I'm looking 50 years out on this one. I'm looking at the real long term. The current dividend, 3.71 per share. That's if I add up the 4 quarterly dividends. I divide that by the share price. I get a starting yield of 3%. Now, what gets me so excited about Pepsi? They're going to likely announce a dividend increase very soon here, any day. And when I look at the last dividend increase from a year ago, it was a 15% increase. And so I am looking for Pepsi to do this again. Anything over 7% would be nice. If they come in at like 8% or 10%, certainly anything over 10% would be amazing. If it comes in with a dividend increase of, say, like 6% or 5%, I won't be really excited about that. It won't change my strategy, but I'm hoping for a dividend increase to be massive because the last one was, and I want to see the yield on cost just compound for this thing. So that is stock #1. Stock #2 that I'm buying right now is my #4 favorite stock of all time. It's United Technologies, and this is a company that only represents 1.86% of my portfolio, so it's underweight. Being my #4 favorite stock of all time, it is underweight, and so I'm trying to bring it to size. Much like PepsiCo, I'm buying this one monthly in 2019, and I'll probably be buying extra shares of United Tech from some of my eBay profits and some of my other ventures as well. So the current price per share is 126 and change. It's kind of towards the top of the 5-year range, but I'll tell you guys, this stock hasn't really gone anywhere in 5 years. It's kind of been in a trading range pattern, and that's okay. I like stocks like that because I don't invest for capital appreciation. I like it when one of my favorite stocks isn't really going anywhere. Quite frankly, this is the reason they're splitting up the company, and the reason that the activists got involved a little bit is because it's not going anywhere. Anyways, actually, in the near future here, they're going to split United Tech into 3 companies, 3 publicly traded companies. One will be aerospace, One will be elevators and one will be HVAC equipment. My hope is that all three will continue to pay a dividend and will increase the dividends over time. I will still look at it combined. So combining the three separate companies, it'll still be my number 4 stock, although it will add 2 net new positions to my portfolio instead of 3 total instead of just having 1. So the analysts expect 2019 earnings per share to come in at $7.91. If I take the current share price, I divide by my $7.91, I get a forward PE for 2019 of 15.97. Thankfully, this one is in more of a value territory than Pepsi. Pepsi clearly is not in value territory here. United Tech, quite frankly, at a 15.97 PE, forward PE, I'll take it. I think that's a reasonable value. It's not deep discount. Deep discount for this would be in the 13 range, 14 range, but I'll take it. I like it. I feel good about buying at these levels. Dividend, $2.94 per share. That's if I sum up the quarterly dividends. I divide by the current share price. I get a starting yield of 2.3%. So really a lower starting yield, not very exciting starting yield. And quite frankly, the growth rate's not that high on the dividend either. The last one was a 5% increase. That being said, I'm looking at the long term for this one. I don't have a lot of industrial exposure in my portfolio. I really like this company. I think they have a lot going for it. I like the fact, quite frankly, that it's so diversified across aerospace, HVAC equipment, and elevators. Now, that is going to change when it's 3 separate companies, but I'm going to, again, treat it as one. And I'm looking at this more from a long-term perspective. I think the opportunity for yield on cost is there, but I'm certainly looking, 20 plus years out for that to happen. At these levels, 2.3% starting yield, it's not going to help me if I want to use that dividend income tomorrow for an early retirement, but it's certainly a trade-off between high current yielders and a stock that is a low current yield, but huge opportunity for future dividends. And look, the payout ratio on this is really low. The dividend is only 2.94, which is much less than half of their estimated earnings per share for 2019. So there's a lot of room for them to increase that dividend over time. I don't need the dividend now, and so it's nice for them to have a little room because they'll grow it. And when I do need the dividend to pay bills, I hope it will, and I think it'll be where I need it to be, just based on the pure financials, that they've got more room to pay. So, as I said, they're splitting into 3 companies, and the big takeaway from United Tech, in my opinion, is it's not... I think a lot of investors are missing this one right now, and I think the reason they're missing it is there's a lot of uncertainty via the fact that they're splitting into 3 companies, and that's created a current PE of 15.97, or a forward PE of 15.97 for 2019, which is a reasonable value, and I think a lot of investors are overlooking this value because they don't want to buy before the split into 3 companies, but I'm taking the risk. I like taking the risk, and I believe I'm going to be rewarded for taking this risk by getting some reasonable values here on my UTX purchases. So the number 3 stock that I'm buying, and I actually haven't been actively buying this one yet in 2019, but I expect to in either March or April, is Cedar Fair. This is a net new position, top 15 stock for me. It's an amusement park company, ticker FUN, and they only represent 1.53% of my portfolio, but I want to grow that over time, being a top 15 favorite stock. And what's great about Cedar Fair is it brings current yield. I like to hedge my dividend growth companies, such as a Pepsi or United Tech, with a slower dividend growth company that pays a huge current yield. I like to have both in my portfolio and hedge them, because who knows, what if I want to tap into my dividends tomorrow? What if I want to start using my dividends to pay bills? Well, Cedar Fair does just that. Current price per share is 53 and change. It's actually at the middle or bottom of the 5-year range, which is good. And the current distribution per share per year is $3.70. If I take my 3.7, I divide by my 53.14, the current starting yield is 7%. And so 7% is a solid starting yield. And what is fabulous is their last dividend increase was actually 4%, which is higher than I would have expected. So seeing a 4% growth rate on a 7% starting yield is fabulous. Now, this company I cannot look at the way I look at these two because it is a master limited partnership. And there's a lot of depreciation with this company because it's an amusement park company. It's a real estate company. They depreciate their assets. And so because of that depreciation, it throws off the GAAP earnings per share. By the way, I'll link in the description below. I've done a lot of videos on Cedar Fair, really good analysis that I highly, highly encourage you to download. It is a really good analysis. Anyways, GAAP earnings per share doesn't mean much here. PE doesn't mean much. But what I look at is revenue. Revenue is up. I look at attendance. Attendance is up. I look at cash flow. And I look at cash flow in a realistic fashion. Like, what is the real cash flow coming from this company? It's up. Debt coverage is up, meaning they can cover their debt even better than they could before. And the stock price is down. And so typically with this master limited partnerships, they're going to pay out in distributions to the unit holders a very similar amount to the cash flow that they're bringing in. And my analysis shows just that. The cash flow kind of matches up with the distributions. For 2017 fiscal year or calendar year, fiscal year, I believe are the same for this company. The cash flow was slightly higher than the distributions, which was very nice to see. I expect over time for the cash flow to grow, the distributions to grow. Now, something to keep in mind with this company, because it is a master limited partnership, it does involve a K1, and actually the taxes are not paid at the corporate level. Again, this is why PE ratios, traditional metrics don't mean as much for this. It's more like analyzing a real estate play. And anyways, the K1s go out to the unit holders. The taxes are not paid at the corporate entity level other than property taxes, I believe. But it's passed through, and we, as unit holders, we receive K1s. And based on those K1s, our taxes are affected, individual tax returns. Now, one of the things that was holding me back on this company in the past is I thought the K1s would, I already do K1s, but I thought buying this one in multiple tranches would create a very complex K1 situation. I now have my K1 for 2018, and my K1, it's very clear, very simple. They keep very accurate track of all the tranches, all the purchases. And so I feel more comfortable now buying this thing in multiple tranches. I'm not going to go crazy and buy really small tranches, but I'm willing to make smaller purchases than I probably would have otherwise. I'm willing to make multiple purchases per year in this company. I don't think it's going to mess up my records too much. And they are, quite frankly, keeping good records for their unit holders, which is something that is new information that I learned from this tax season. So I really like owning this this master limited partnership. But do keep in mind, if you're an investor for dividends and cash flow, there are additional responsibilities from an accounting perspective, from a tax perspective, that do come with a company like Cedar Fair, a master limited partnership. So you want to make sure you are up for that before purchasing something like this. Certainly I am, because I already have to file K1s on my tax return. I have a system in place where my tax preparer is very aware and competent and able to handle my K1s. And so I feel fine having this additional K1. But again, I want to bring this company a lot bigger in the portfolio because of the hassle of the K1, it needs to be driving a pretty substantial amount of cash flow for me. But I love it. I'm happy to buy at a 7% starting yield on the distributions. Really happy about that. And I'm excited this one's kind of staying lower. Some of my other bargain basement stocks like BTI and MO, those are starting to trend up. So I'm not as excited about those these days, but they're still reasonable, good values. But Cedar Fair, it's kind of sticking down there. And so I like the fact this one's still on sale. And I like the fact that this one's kind of on sale. This one's not, but I just gotta stack up my PepsiCo, gotta build that position. So in terms of full disclosure, I am long on the stocks mentioned today. I am long on Johnson & Johnson, ticker symbol J&J, on BTI, ticker symbol BTI, Altria, ticker symbol MO, PepsiCo, ticker symbol PEP, United Technologies, ticker symbol UTX, and Cedar Fair, ticker symbol FUN. I own all of those in my personal stock portfolio. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest money in the stock market or anywhere else, please consult your licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun. And if today's video is not tax advice, if you're going to be filing taxes and you're thinking about the implications of qualified dividends with Pepsi and United Tech, or master limited partnership distributions like Cedar Fair, please consult your licensed tax advisor. By the way, I did a YouTube video a while ago on dividend investing and taxes. I'll link in the description below. Doesn't talk about master limited partnerships, but does talk about other types of dividends. So I do believe some of you guys will find that really exciting. All right, everyone. Hope you enjoyed the video today. Please share in the description or in the comments section below. We have a thriving community. We're almost at 25,000 dividend investors strong. If you have a particular stock that you like right now in March or April of 2019 that you have your sights set on, that you're accumulating right now, please share it with the community. Everyone, if you want to support this channel, please subscribe. It means the world to me. Also, check me out on Instagram and Twitter. I will link in the description below to my Instagram and Twitter profiles. Please follow me there as well. Thank you so much for your support. I will see you in the next dividend investing video.